Victor Yang, Senior Editor at JLC Network Technology, because of course, Victor, in terms of the volatility we saw yesterday and recent days, there's a question mark emerging as to how significant the COVID lockdowns are in China and what impact it will have on demand. I welcome your answer to that question.
Yes. Well, I believe there's been a lot of coverage on the COVID situation in China nowadays, because, the country has been largely successful in containing the virus before March. And now we have reported over 1,000 cases of indigenous cases were confirmed cases on a daily basis, and thousands of asymptomatic cases were particularly in Shanghai. So as you know, Shanghai has been locked down for 2 days. Half of Shanghai, not the whole city, but the other half will come under lockdown.
Shanghai is a bit like Budapest. There's two sides to the city with the river in the middle. One side is closed while the other side is open.
Yes, that's true. And they will be locked down separately for 4 days. And Shanghai is a very big city. It has a population of 25 million. You just imagine the population, 25 million, close to a small country. This has a kind of significant impact because Shanghai is not just a big city, but it's also an economic hub for China. So it's kind of psychological impact too. But first of all, there is fuel demand impacts too. Say in Shanghai, fuel demand has plunged by 60 to 80%. So this is a particular, you may say it's particularly serious in Shanghai now, but restrictions are similar all over the country. Say travel restriction across between provinces or even between cities. So travel has declined a lot, and it would be common to see petrol sales declining by about 30 to 60% since the middle of March. So that's why China has now planned to continue with gasoline and diesel export in April. And in early March, you might have read some reports about China planning to suspend exports in April to ensure domestic supply, because independent refiners' run rates had declined quite sharply. But now, as domestic demand has dropped sharply, they plan to continue with exports in April again. So that's just one indication of how significant the impact on fuel demand is. Yes.
Perhaps in a strange way that China can maybe help to moderate this oil price if the oil producers won't, and that is by, instead of the world looking for more supply, maybe less demand from China would be helpful to this oil price. And we saw that yesterday when there was a sense that this COVID lockdown in Shanghai and may indicate a wider lockdown in China with less demand, and hence the price could ease off a bit. But Victor, we've talked each time, every month you join us, what the outlook for the year as a whole is. And the question again, last year we saw Chinese oil imports drop for the first time in 20 years. Are we going to see again this year, now at the end of first quarter, where we have a better sense of the year, that the possibility that a second year in a row Chinese oil imports could decline? Is that possible, probable?
Yes, I would say that's probable. Yes.
Probable.
No. Yes. And you see now independents are running at quite low rates, 2-year low. See, and state-owned refineries are still running at quite high rates, because they were in early March they were trying to ensure domestic supply, but now demand has plunged, and so they tend to cut their run rates too. And there's increasing maintenance at state-owned refineries too in this season. So basically now the buying interest is quite weak among independent refiners at this moment. And so we see this as a trend. We are not going to, do not see it too well. We do not expect it to change very quickly yet in the near term. And it depends on how soon the country can bring the virus under control again. But this time it looks harder because we are talking about, well, infections in many cities, and in a certain city, say in Shanghai and in Jilin province, well, hundreds of cases on a daily basis, well, because there's this kind of, well, shortage of medical workers, well, and such stuff. And it's more challenging than even, well, except at the beginning of 2020, when the outbreak hit the country all of a sudden. And this is the most challenging moment for the country.
Well, no country in the world has managed to control Omicron.
Yeah.
The illness level has been a little bit less, obviously, but the spread has been so rapid that no country has succeeded to do that. My question to you on that point is that obviously Shanghai, as you said, it's not a huge, I mean, it's a big city, 30 million people, obviously, but it's more a financial center rather than a manufacturing center, which is manufacturing is a bit removed further down in the southeast there where you are generally. Is there expectation that this shutdown will spread to the manufacturing areas?
Well, at this moment, some manufacturing has been impacted. But on the whole, the manufacturing will not be, well, hit too much if the country, I mean, if Shanghai is just locked down for, say, altogether 8 days, 4 days for half and 4 days for the other half. And manufacturing will be back to normal quite soon if this doesn't worsen. I mean, the situation doesn't worsen. So we are not expecting a lot of damage to the manufacturing yet.
If you say probable that Chinese oil imports will decline in 2022, by how much would that be? 20%, 10% on last year? What would your sense be?
Well, it wouldn't be so significant. I believe it would be, for this time, it might be below 10% because of the high price as well, the violence as well. And, you know, last time when we talk about the impact of high prices on China, well, there's a financial burden on the government too when when crude prices are high. Say, you know, the Chinese oil market is not a completely free market. The government regulates oil prices, I mean, oil product prices to a certain degree. Say, if crude average between $40 and $80 per barrel, the government would calculate oil product prices, well, on a normal level, at a normal level. Say, they will, well, include normal refining margin into the calculation of oil product prices. But if crude is above $80 per barrel, the government will cut the margins in the calculation of oil product prices, which means refiners will get less margin when prices are above $80. And if it goes higher, the margins will drop further until the margins are zero. So if the crude price is above $130, well, in principle, the government will not address its fuel prices, which means domestic oil product prices will lag behind and much worse margins for independent refiners. So what do they do? What do the refiners do? They need profit to survive. The government will have to subsidize state-owned refiners to ensure domestic supply. But the subsidies will not be enough to cover all the loss, but it's still a very heavy burden on the government.
Looking at the immediate sort of global outlook, there's a big question mark about whether Russia or China will be willing to buy Russian oil, cheap Russian oil, whether China will be willing to support Russia in a very overt way in this war. What is your own sense of the buying of Russian oil, for example? Do you think there will be much appetite in China?
Well, independent refiners would hesitate to take more barrels from Russia because of the risk in, say, payment, shipping for them. But for state-owned refiners, well, they would find it more attractive. I mean, find these barrels more attracting well. So for independent refiners, well, they had so far cut their buying of Russian barrels. Well, but for state-owned refiners, well, they may have no issue with such barrels from Russia. And so long as they can fix the problems regarding, well, difficulty caused by the sanctions, well, then there's no issue with them. That's my sense of them.